Hi everyone, it is Corey here, founder and financial advisor at Verse Wealth. We hope that you are all safe and well. That is you, your family, your friends, and your community as well. These are unusual and challenging times for all of us in so many ways. Really unprecedented. I've been cooped up. Ash has been cooped up. Our team's been cooped up, working from home. The last 6 weeks, I think. I myself have had a 3-year-old and a 5-month-old to navigate my day with. The 3-year-old kind of jumping into plenty of my client meetings. I'm sure plenty of you have seen Brady half naked in recent times, so that's made things interesting. But hope that you're making the most of the isolation and going really well. So the purpose of this video is to give you an update on investment markets. We of course have seen some really wild swings in the last 4 to 6 weeks. We've seen that initial downturn from Feb 20 when things got quite chaotic there, and things have kind of stabilized and rebounded a little bit in recent times. So what we want to do is really kind of answer 4 key questions for you today. Over the course of the next 5-10 minutes, we'll be having Ash here. He'll introduce in a moment to help me do that, but really kind of asking what's driven the recent rebound we've seen on investment markets in the past 3 weeks. An important question of, might we see markets go lower than where they were, say, on March 23, which was the recent low? The question of, is now a good time to be investing? We are getting that question really consistently from clients and also people that are coming on board and seeking advice for the first time. And also too, just helping you better understand what's been happening with client portfolios behind the scenes in recent times to navigate the downturn, but also the volatility on markets as well. So I've got one of our financial advisors here from Verse, Ashley Bishop, to join us. Ash, thank you for making the time there, mate.
Thank you very much for letting me join in with this conversation, Corey, and hello to everyone. And definitely want to mirror what Corey has said. Hope everyone is keeping well out there and looking after themselves physically and mentally, because it's, as Corey mentioned, a very unusual time, and absolutely important to be looking after those things. But as we said today, Corey, here to talk about the markets and help people with their financial life as well.
Well said. So the first question I've got for you, Ash, is really what has driven the rebound on markets in recent times. I've just pulled up a chart here. We've got the S&P500, so that's the 500 largest companies listed on US stock exchanges. We can see here that from Feb 20, that was where things really turned, down to March 23. We saw a 75% fall in the value of that market, and our market was virtually identical. Yet in the kind of 3 weeks to 4 weeks that have followed, we've seen markets really rally. The Australian market has rallied about 16-17% since those March 23 lows, and the US market is actually really a little more, closer to 25%. So just help us understand, what has shifted in markets and what has driven, that bounce that we have seen.
Yeah, absolutely. I think it's important when we talk about the bounce, we need to really reflect on why we're down to those levels. And clearly it's the COVID-19, the coronavirus crisis. But a lot of the reason the market really came down was, and often does in a situation like this, is fear. Fear and uncertainty, to be more accurate, is that people didn't know what was happening. They didn't know the full range of the health crisis we were in. And that caused people to sell off their assets because they just didn't know when everything was going to clear up. They didn't know when it was going to stop. The reason then that we've had the turnaround in that time is really down to 3 factors. Now, the first of those is the response from the Reserve Bank and the government to what they realised was actually a very, very deep crisis that we were entering into. In terms of the Reserve Bank, that's what's called monetary policy. And what they've done is implement a policy called quantitative easing, which you would have seen in the news and is often referred to as QE. And what that is effectively the Reserve Bank has been buying up bonds to create liquidity in the financial markets in Australia. On a practical level, what that means is that debt becomes much, much cheaper, which means that the banks in Australia, so the big 4 obviously and other banks as well, have a lot cheaper debt that they can in theory lend out to businesses, which means that over time, when those businesses need access to debt, they've got the access there, they've got liquidity, And it just means that the system is supported. They're not losing access to cash at the end of the day. And that's really, really important because all markets function on being liquid generally, especially the share market. And that's really put a lot of confidence in people that response has been appropriately managed. In terms of the government, so that's what's called fiscal policy. And what the government has done is really pump money into the economy in order to keep it going. Now, there are a few ways they've done it, but the best two ways to refer to it are really around the job seeker payment and also the job keeper payment. Because what those did is they made sure that people had income at a time where they'd be losing their jobs or having their income slashed or their shifts reduced. And from a practical perspective, it means that if people continue to have income, they should still be able to spend some money over a period of time, as the government's flagged, at least 6 months from the implementation of those policies. And it gives people the confidence, and in particular the financial markets, gives them the confidence that when we are eventually allowed to move around and social distancing restrictions are reduced, that people will have some more income. Maybe they'll start to spend a bit more money. Maybe that means the economy, because other businesses can start to open and re-employ their staff. It means that the economy, in theory, will increase or will recover a lot more quickly. And that's given people confidence that they can invest in these companies in the stock exchange as well, in the share market. The third part of that, as I mentioned, though, is really just optimism. So if we talk about fear and uncertainty leading to the market coming down, the opposite effect then is true when people feel optimistic. And in terms of the health crisis, in particular in Australia, New Zealand, and some other parts of the world, you started to see a flattening of the curve in terms of new coronavirus cases. And over time, that has given people more optimism. And as I say, in particular in Australia here, where we've done relatively well, compared especially to other countries in the Northern Hemisphere. And so that optimism means people are thinking, you know what, the market's come down so far, maybe we can get some cheap deals and cheap investments than it would have been maybe 6 weeks ago. And hopefully over the long term, if we do have control of the spread of the COVID-19, then perhaps now is a good time to be investing. And that's what people have done with that optimism.
Really well said, Ash. One thing that we're always reinforcing with clients is the importance of investment behaviors and discipline, and really not getting too wrapped up. And it's easier said than done at points, like we've been through in recent times. Not getting too wrapped up on the short term and being able to kind of zoom out and look at the bigger picture. And the fact that markets will always overshoot. They'll get too high. They'll get too expensive. The participants are human beings, and collectively we're quite a predictably irrational bunch. So you'll see the best weeks follow the worst weeks, the best days follow the worst days, the best years follow the worst years. Getting to the end of last week, the US market had its best 30-day stretch in, I think it was 46 years, since 1974. That just gives an indication that markets get oversold. There's value in markets, and when things shift and optimism returns and some of the fears mitigated to a degree, you can see markets rebound as quickly as they fall, which is why you don't want to be making these big moves out into cash, because you find yourself missing out on those really sharp and significant upswings as well. So, interesting times on markets, and it's not to say we've seen the end of the volatility. We probably haven't, and it's probably a good segue into the next question that we've got for you, which is, we were talking about markets having that 35% fall down to 23 March. Might we still see markets go lower and retrace that level?
Look, the short answer is absolutely possible. Realistically, we talked before about optimism, saying that optimism around maybe we've got control of the spread or if we've flattened the curve. If, for example, and at least if we just talk about the Australian market, if you see what they call a second wave of infection come in, then that's likely to dent confidence, and that's going to create more fear and uncertainty we talked about. So that's likely to have an impact on the market should it happen. I guess the one thing is we just don't know what's going to happen, and that's why these times are so, unusual, as we can't predict the future pretty naturally. But ultimately, we do need to remember that this is going to be a significant economic event. A lot of people who are watching this will have seen in the news how we're looking at a sort of the worst figures since the Great Depression and so forth. So right now, I think people are focused on the health crisis, and that's completely the right thing to be focused on. But the bad news can potentially come from that. But then if we get more bad news in the future around actually the economic damage is worse than expected, then that could have an impact and force markets down as well. Part of the reason we talked about again before, the reason markets have recovered is because the policies have been put in place in terms of like job seeker and job keeper that give people confidence that the worst of the economic damage has been done and now we have a pathway out. But if that turns out to not be the case, because remember we have a long way to go before we're back to normal, so to speak, then there's always potential for the market to be coming down. But at the same time, I guess we'll segue into this question later on, doesn't mean it's not a good time to be invested.
Yeah, really well said. And one thing to note too is, if we see a downturn of let's say 35% on the share market, it doesn't, as a client, it doesn't necessarily mean that your portfolio is down 35%. You're all going to be familiar with the concept of asset allocation, which is really that decision-making process of how much of my money is in shares, property, cash, and fixed interest and bonds, and in what combination. And that really will drive the long-term returns, but also it will affect how far and how quickly you can see your portfolio fall in value as well. So in a general sense, if you are, say 50 plus, you're moving closer to retirement, or perhaps you're in retirement, you're going to have an asset allocation that isn't as geared towards the share market. You might have, say, 45, 50, 60% exposure of the portfolio to investment markets, but maybe, 40 to 50% might be exposed to cash and bonds and deposits. That's going to provide you, and it will have been providing you some insulation against the downturn. I think we've spent time with virtually every client in the last 6 weeks and reinforcing some of these concepts. And if you are younger, your portfolio is more likely to be geared to those growth assets. You're more likely to take a hit in the short term. But having said that, investing is not about the short term. It has always been, will always be about the long term. You'll have an asset allocation to help you magnify gains over the long run as well. So
yeah, look, absolutely. I think there's a term that's called risk-adjusted return, and ultimately, what that is, it's about the level of risk you've taken to get the returns that you've achieved. Now, one of the things that you'll be seeing in the news at the moment is around, say, for example, your industry super funds, where they've talked about having a balanced portfolio, but in reality, the growth assets have been sort of closer to 70, 80% in terms of the overall asset allocation. Now, everyone's been happy with that when it's been 10, 12% returns every year, but it turns out people have taken a lot more risk than perhaps they realized, but they were happy with it because the returns are so good. And that's why I think to your point, Corey, the asset allocation that you have is really, really important for you, not just for your stage of life, but what you're trying to achieve and what your goals are and your priorities, because you don't have to go out and get sort of the highest percentage return you can, because if it doesn't match your stage of life or what you want out of your finances, then you're probably making a mistake, and that's where you're going to find yourself in trouble and more fearful in situations where markets do downturn.
Thanks, Ash. Well said. In terms of markets obviously coming off quite a bit in recent times, is now a good time to be investing? I think I've heard that question a couple of hundred times in the last month. So what are your thoughts?
Look, and it's a great question. And the answer is really, it depends on your situation. So if, for example, in this hypothetical, you're someone who's saving their house deposit and you want to buy a home in the next, say, 6 to 12 months, then the answer is probably no, because you've got a short-term goal. And as we talked about, there's going to be a lot of volatility over the next 6 to 12 months, potentially, because there's just so much that we have to go through realistically before we return to some sort of whatever we end up calling normal going forward. But for those clients who have a longer term time frame, then the answer is potentially yes. And again, it depends on their situation, if we refer to your points earlier, Corey, about how over the long term, and we can talk a bit more about this, if markets continue to work the way they should do, and ultimately these markets are just made up as a series of companies that are all looking to make money, make profit, increase the value of their company, then there's no reason why that shouldn't continue going forward after this crisis. But it is going to take time, and so having a long-term time frame is going to be really important if you are looking to invest now. But as you said before, markets have come off a significant amount over the last 6 weeks, and has created a great opportunity for those who are willing to invest their money and do have a long-term time frame to potentially have almost a once-in-a-lifetime opportunity to really get in at really cheap levels. And as long as they're comfortable with volatility, as I say, there are going to be good days, there are going to be bad days. But if you're willing and able to ride that time out with a really good time frame and the right asset allocation, then yeah, now could be a great opportunity. But again, you want to discuss it with your advisor, because it does depend on your individual situation. There is no catch-all answer to that question. It just depends on you and what you want.
Spoken like a financial advisor, Ash. It is important that if you are investing, and we're having these conversations with many of you at the moment, that you take some prudent steps to manage the volatility. So, we haven't seen as much volatility in the last 4 weeks, but prior to that, we were seeing even like 12% intraday swings between like 10 a.m. and 4 p.m., the trading day for the market, and, seeing weeks where the market's down 10%, it can be up 10%. So you need to manage that volatility. And the best way to do that is by not making big moves in or out of a market. And if you are investing, making sure that you're staggering your entry into the market over an extended period of time. It could be multiple weeks, it could be 3 months, it could be 6 months. It's dependent upon your situation and what you're trying to achieve. But we might see markets fall below those March 23 levels. During the GFC, it took us 14 months to go from those record highs down to the market lows. I'm not saying we're going to be repeating that, but it historically would be unusual to go from top to bottom of a market crash in 32, 33 days. So if you are investing, expect markets to go lower, have that mindset, want them to go lower, because you want to be buying in at the lowest levels you can. The lower asset prices you're buying at, the higher long-term compounded returns are going to be as well. So great long-term opportunities, but you just need to manage it with prudence and manage that volatility. Don't dive headfirst into the kind of market that we're in at the moment. And one thing I will just add to one of your points there as well, Ash, is around the economic recovery. Like it's not going to be super quick. It's going to be staggered. It's going to be complicated, not just for us, but globally as well. We might have our borders closed for multiple years potentially. So it is easy to think that the economy and markets are kind of one and the same thing, but they are in fact separate. They're correlated, of course, but markets always crash before economies do, and markets always recover well before economies do as well. Markets are looking 2, 3, 4, 5 years in advance to try and figure out what the earnings of these underlying businesses are going to be doing, whereas the economy is kind of living in the present day or in the most recent past. So we might see economic activity really still struggling, but markets really rebounding really aggressively at the same point in time. And we've seen that the past month. We've seen people losing jobs hand over fist, and the economy falling off a cliff essentially. But we've seen one of the best months we've ever seen on markets in the last 30 days. So that gives you an indication of what I'm saying.
Yeah, absolutely. And I mean, I heard a great point made, and not by me, I should point out, but I'll repeat it and forget, unfortunately, who provided it. So apologies to them. But they made a great point that when we talked earlier about monetary policy and quantitative easing and providing a lot of cheap debt to the market, so there's liquidity in the market, that does mean that all that money now exists and has to go somewhere. And given interest rates are so low, most people are not going to be leaving that money in the bank over the medium and long term. Now, certainly in the short term, when there's a lot of volatility, maybe people are holding some more cash just to see how things go. But over a period of time, you've got really cheap debt and cheap money. It's all going to have to go somewhere. It is a reason that the market recovered so well after the GFC, or the Great Financial Crisis. Interest rates were low. People had to put their money somewhere to get some sort of return. It went into the share market. It went into property. There's entirely likely that potentially may happen again. Now, how people's mindsets are around those assets will obviously be interesting. It's something we just can't predict. But realistically, if you had the choice between making returns in the share market or making 0.5%, one or maybe lower in your cash account, you potentially see where people are going to put their money, and that's going to help share market recovery as well.
Well said. And in terms of, finally, I guess before we wrap up, conscious of time, in terms of client portfolios, so there's always things happening in the background. So our role as a financial advice firm isn't to make the day-to-day investment decisions. We're not choosing, CBA over NAB or BHP over Rio Tinto, or we're not shifting the exposure to the US market and amping up the Japanese market marginally. We leave those tactical decisions to the asset managers that we choose to have in your portfolio, and they have their own investment committees that meet on a predetermined basis. Quite often it might be 90 days, and they'll make adjustments to the portfolios and the portfolio settings based on what asset allocation they're looking for, to manage risk, but also try and enhance performance as well. When we go through downturns and volatile times like we have been through, those asset managers will tend to meet on a far more regular basis, and make more regular adjustments to the portfolio. So as a simple example, as we've seen share markets fall in value in recent times, proportionately that becomes a lower portion of your portfolio. What those asset managers will do to counteract that is they'll increase the weighting, say, to the share market once they've fallen, to make sure that you've got the right asset allocation settings as well. So many of your portfolios will have been buying, without you knowing it, assets at lower prices in recent weeks and months as well. So we're talking with you individually about your own portfolios and asset allocation, and making sure you've got good expectations, but there are adaptations that get made to those portfolio settings in difficult times like this. So I think we've covered most of what we want to cover today. Ash, appreciate your time. Appreciate your advice.
Yeah, thank you for yours, and I hope everyone has a great weekend. Continues to look after themselves, and look forward to next time.
Absolutely. And as you said, take care of yourselves. We are talking with you all on a really regular basis. I've certainly felt myself as an advisor that we've, in the last month or two, have never been more valuable for the clients that we work with as well. And there's plenty of people out there that would value advice and guidance at a time like this. So if you've got family or friends or colleagues that you think would value talking to Ash or an advisor in our team, please, you're welcome to get them in touch with us. We'd be more than happy to help. But in the interim, we'll continue to help you all to the best of our ability, and look forward to talking with you all very soon.
Thanks, guys.